Hello, this is Miles Tullo bringing you the JD Power Financial Services Intelligence Update for September 2024. This month, we're discussing all things mortgages. Every year, we survey over 20,000 mortgage customers about their experiences and satisfaction levels with their primary originator or servicer. The results cover 60 of the nation's largest originators and servicers. Bruce Gehrke leads mortgage research for JD Power and has joined me today to discuss our latest findings, including how future borrowers are engaging lenders earlier in the process than ever. Welcome, Bruce.
Thank you, Miles. Great to be here.
Excellent. Bruce, let's start with who we're surveying. I mentioned we capture feedback from 20,000 mortgage customers annually. Can you tell us a bit more about who they are?
Yeah. We collect data from basically the customers of the most successful mortgage brands in the country. So we're looking at, for instance, for lenders, 31 of the largest retail mortgage lenders in the country. And for servicers, the top 35 consumer recognized mortgage servicing brands. We collect across these two components in these segments a representative sample of all demographics of the American homeowner population as well as the home buyer population.
And so what are they saying about mortgage originators and servicers today?
The overall industry is showing a downturn in satisfaction amongst the customers, which is interesting because last year we saw a significant uptick. The other part of that we find interesting is only 42%, less than half of the lenders out there are actually achieving higher scores this year than they did last year, where a full 70% were improving from 22 to 23. So there's definitely a trend into a little more challenging time for lenders. For servicers, the story is a little bit different. We see servicing satisfaction up significantly this year for the entire industry. What makes that interesting is what we've seen in our sample is a significant growth of more financially challenged and vulnerable and ultimately at-risk customers being served. And this group is traditionally much more difficult and challenging to serve. So to see that increase in overall satisfaction with those headwinds is pretty remarkable, and I think speaks well for what's going on in the servicing industry.
Got it. Let's talk about the lending side for a moment. Against that backdrop, what's driving loyalty and advocacy for borrowers?
Well, really, the number one factor in that, and this is, I don't think any surprise, is really developing trust amongst your customer base. But for lenders, that's a little bit different because what we're doing is we're looking at customers after they sort of transit that halo period right after they close a loan. So we're getting folks as they look back on the experience with a little bit more practical perception. And what seems to resonate in their mind or what they carry forward, which really impacts their loyalty and advocacy, is the perception of how easy that process was and whether or not they got a good deal. At the end of the day, those interest rates matter. And a customer needs to believe and trust that their lender gave them a good deal. But that being said, that is somewhat consistent and it's outside of their control. Interest rates are an external factor, and most lenders really can't control the market. They have to be competitive, and if they're competitive, it really comes down to how fast, how easy, and how transparent that process was. And those things really resonate and stay with the borrower, and that's what drives recommendations and referrals as they go through their new home ownership.
And how about on the servicing side?
Servicing side is similar, but a little bit different because trust here is important, and trust drives referral from that servicing portfolio for servicers. And many servicers are looking to maintain that portfolio by offering good refinance rates and being able to keep those folks as customers as they go forward. Here, though, it's a little bit different. There's not a lot of touch points between a servicer and their borrower. So really here, an excellent experience is one of those that has very little interaction, very little necessary interaction. So what servicers are trying to avoid here is any problems or any questions that they can't answer. And the key again to that is communication and creating some transparency. What to expect, what they need to know, and what impacts them going forward. And the two primary areas of that we found are understanding what fees they may be exposed to and understanding how well their mortgage escrow account is managed. That's become forefront recently. We've seen a lot of changes in insurance premiums across the country, as well as property taxes going up. That's putting some pressure on servicers to keep increasing those mortgage escrow payments. And for the customer, knowing what's going on there is crucial and critical to their ability to trust that mortgage servicer with their money.
Got it. When you think across the entire mortgage landscape, what's been most surprising to you year to date?
Well, really, from the servicer perspective, it's that dealing with that challenged group. We see an increase of borrowers who are concerned about simply staying current. And that group is creating a higher level of anxiety between them and their servicer. So to be able to meet those needs, I think, as I said earlier, really stands out. And what we're seeing there is effective use of new digital capabilities and making self-service options available to customers where 24/7 they can go in, get answers to simple questions, get answers to more complicated questions, and not having to reach out, spend time in call centers, etc. And that seems to be really, really resonating with customers. For originators, what we're seeing is the opposite. We're seeing the investments that they've made in digital lending not really delivering. Of the 6 dimensions that we measure in the experience overall, the digital ratings are the lowest out of all 6. And so what we're seeing is a little shift in the market, and where lenders who rely more on an analog process, a traditional distributed retail model where you're focused on loan officer interaction and interaction with local processors and underwriters, etc., that seems to be driving better experiences. So those people ratings are the highest amongst those dimensions. So it's an interesting twist and something definitely different than we've seen over the past 2 and 3 years.
Makes sense. When we think about rates, obviously been elevated for a while. They will come down eventually. What impact will that have on these dimensions of satisfaction that you've referred to?
Well, I think rates will impact, obviously, the industry dramatically. We've seen a reduction in volume significantly so, and happening very quickly. Cyclical changes in the industry are not something that's new. It is a part of the mortgage lending business, but never has so much happened so quickly. So the result of that was simply a lot of layoffs. We saw firms go out of business, and we saw a lot of consolidation in the industry. What we're going to see going forward, that has impacted the way firms are interacting with their customers. So what we're going to see going forward is some better volume flow as interest rates come down. It puts the focus, as we mentioned, on that trust and that advocacy, because as folks who came in at those high interest rates now get to the point where they may be able to refinance, that refinance business starts to come back a little bit. And that will impact those lenders that use a direct-to-consumer model, which tends to favor the refinance experience. So we'll see some shifting of that. We'll also see some increase in trade-up borrowers who had traditionally low interest rates and were reluctant to trade up to another property because they did not want to give up that low payment. Now, as interest rates come down, that differential is less, and they're more likely to enter the market. So we're more likely to also have some more purchase business as well, and it becomes more and more competitive for the lenders.
Well, Bruce, thank you very much for joining me today. The J.D. Power U.S. Mortgage Origination Satisfaction and U.S. Mortgage Servicer Satisfaction studies are available now for our subscribing customers. More details are in the post, including a link to register to receive our mortgage research press releases so you can stay on top of our latest insights. I'll be back in October to discuss findings from our brand new financial protection study, where we ask consumers about their satisfaction with bank and credit card issuer fraud protection, intervention, and resolution. We'll see you then. Thank you.